Hello, I'm Terry Daniels, Director of Trust Investments with the Wealth Management Group at CNB Bank & Trust with your first quarter 2018 market update. Stock momentum turned negative during the first quarter of 2018 as investors grew concerned about tariff talks and higher interest rates. Briefly, looking at the first quarter, the Dow and S&P were down for the quarter while growth-oriented Nasdaq was up. More mature developing markets were down while growth-oriented emerging markets were up. And prices for current bonds fell, causing yields to rise as the Fed raised rates with at least 2 additional increases expected for the year. And finally, gold was up while the US dollar was down due to tariff talks. Looking specifically at the major US indexes, for the first quarter the Dow Jones Industrial Average was down 1.96%, the S&P 500 was down 0.76%, and the tech-heavy Nasdaq was up 2.33%. Looking at stocks by market cap and sector performance, large growth stocks were the best performing in the first quarter, up 4.01%, while small value stocks were the worst performing, down 5.18%. Tech stocks led as a group, up 3.7%, while U.S. real estate lagged, down 6.65%, and dividend-paying stocks lagged growth as well, as higher interest rates put pressure on prices. So what has fueled stock prices up to now? The combination of a slow global economic recovery, along with lower corporate taxes, lower interest rates, and a relatively calm geopolitical environment have all been healthy for stock prices through the end of the year. So what's putting pressure on stock prices now? Tariff talks during March have hurt U.S. export sales. For example, according to the USDA, over half, about 56%, of U.S. soybean shipments went to China in 2017. Higher interest rates hurt profits and also slowed stock buybacks by companies. Also, we saw some profit taking recently as investors shift to a risk-off mode. And finally, there's some near-term uncertainty on first quarter corporate earnings as companies report results in the coming weeks. As we've stated before, the S&P 500 is priced for perfection, with the current level of the S&P 500 higher compared to the peak of the technology stock bubble in 2000 and just prior to the global financial crisis in 2008, with valuations equally stretched. So what should investors do now? First, we should expect continued volatility near term as companies announce first quarter earnings. Secondly, we should have realistic expectations for returns. 2017 stock returns were more than twice the historical average. Also, in times of market volatility, we think it's good to keep some powder dry. That is, have higher cash balances to cushion near-term volatility and to have cash on hand to buy quality stocks at a more attractive price. Make sure you diversify accordingly based on your risk, time horizon, and liquidity needs. That means have the proper amount of cash, bonds, and stocks based on your circumstances. And lastly, stick to your investment strategy. Don't trade unnecessarily. That means conducting regular investment reviews to make sure your portfolio's asset allocation is in line with your risk tolerance and time horizon. This typically means that the mix of stocks will decrease while the mix of bonds and cash will increase as you near retirement. But each person's circumstances vary. If your portfolio has become unbalanced due to recent market activity or your needs have changed, please contact a member of CNB's Wealth Management Group to see how we can help. Thank you for joining us.